Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Mike, great to be able to catch up with you again. Your insights are very valuable to our viewers, investors, and people who want to really understand the market, which is, I think, pretty tough right now because we continue to see record highs. But at the same time, too, there's a lot of uncertainty, a lot of unknowns in terms of what the right trends are going to be and what you have to get right to continue to make money and not lose money in this market. So with that said, why don't we kind of just start with your kind of top-down view in terms of some of the issues that you have to think about in managing money?
Sure. Well, thanks, Catherine. And it's nice to be here. One of the big factors we have to deal with is we do see growth. We do see the economy rebounding, and we do see more people getting vaccinated in Canada and different parts of the world at different rates. What we have to deal, or I have to deal with as a manager, is whether we're actually seeing peak growth, and if growth is plateauing, and if growth is plateauing, what is the next level? Trying also to understand the conundrum of, even though growth is plateauing, you're seeing decent growth forecasts for 2022, may not be as high as the third and fourth quarter of 2021. But why are bond yields declining so much? Is that the bond market is seeing something strategists or the equity markets aren't seeing? Also have to deal with some of the bigger weather or climate issues. Very hot in Western Canada. How will that impact crops? Could that lead to an additional increase in food inflation? We saw logistic issues going as far as the Suez Canal a few months ago. And now we're seeing some logistic issues, transportation issues. Well, firstly, in trucking, sometimes, in many cases, there's a shortage of drivers. With rails, we unfortunately saw a town in BC burned down. It also burned down a key rail link, a bridge. So just the transportation logistical issues, how that will play out in the economy. And for the small and medium-sized business owners I speak to, the men and women who run these companies, it's a hard time finding workers. So when the government support programs end, it looks like they'll end sooner in the US. Will these workers go back to work? And will they choose to go back to their same type of job or industry, or will they find new jobs?
So a lot there, certainly to be thinking about and to unpack and trying to position yourself, your portfolio, other people's money in the right way. I want to go back to the big question right now, of course, which is, are we seeing peak growth? There's a big debate on that. What do you think? And in combination with that, when you do see these bond yields decline to such a degree, what's that telling you in terms of what the bond market thinks growth is going to look like in 2022?
Yeah, I guess the bond market is huge. There's many aspects of it. So as we've witnessed government bond yields come down, we would maybe sometimes in the past look to something happening in the credit market as a credit event, but credit spreads are still very tight. That's the difference between the lower yielding corporate bonds versus the higher yielding corporate bonds, plus the corporate yield spread to the government yield spread. So things are unfolding differently than in the past. Number of things happened earlier in the year. Bonds had one of their worst declines going back 30, 40 years. So we think there was some position rebalancing, people going from equities back into bonds. And also people may want to be smart and get ahead of the Fed, because if they think the Fed is going to raise rates, they think there may be one raise and that's it, and then rates will go even lower. So I would say the U.S. and to a lesser extent Canada, for some bond investors, is seen as a safe haven. So that causes some flow of funds to come into US and Canadian bond markets. So right now, the riddle is still not solved, but we'll see how it unfolds, because you still have very many smart and astute strategists who are predicting bond yields to be higher by the end of the year. So we'll have to wait to see how that unfolds.
Yeah. But Mike, at the same time, too, we also have very astute strategists, economists, and bond money managers who think rates are going lower. I mean, it's very divided. And there's smart people on both sides of the debate. Very smart people.
That's right. So if you think bond yields are going lower, you obviously think you buy into the camp that inflation is transitory. Transitory never being defined, but that this burst of inflation will end quite soon, call it maybe 1 to 3 months. I don't see it that way, as when I talk to the heart and soul of the economy, the small business owners, there still is supply issues. Like, for example, one business owner told me he used to pay $3,000 for a container coming out of Asia. Now he has to pay $14,000. So that may come down moderately. Still a shortage of truck driver. We see wages rising, hard time attracting workers back into the service industry. So if you truly believe in that, which I'm not in that camp, then you might make a case. But like, don't forget, central banks lower rates to really low levels historically, 80, 100 years, because the economy is facing a shock or a crisis. Last one was a real estate induced leverage crisis. This time was a virus pandemic. So I'm not in that camp. I'm not in the camp that we get 7 or 8% inflation, but inflation will steadily rise. So at some point, rates, have to reflect that, reflect higher bond yields.
And in terms of growth, do you think we're at peak growth? Or, I was listening to Kathy Wood, ARK Investments, and she was saying, I don't want to paraphrase, but basically, even if we're at peak growth, scarcity, you want to own the companies that actually are true great growers. So you can still win, even if in terms of owning growth companies, if we're at peak growth. But where do you stand on these comments?
Right. So, if you look on a graph, you'll notice a dramatic V-shaped bounce in the economy. You've had records amounts of government stimulus, trillions of dollars. So I do believe, the fantastic growth that we see in Q3 and Q4 most likely won't be replicated, and we won't grow at that rate. But if we end up growing in 2022 at 4% in the US, that's still a very good growth rate. You'd have to go back to the mid 80s to get somewhere there. And if Canada could do 3.4, 3.5 for mature economies, that's still good. Another factor in the US market, S&P 500, you have 5 companies that really dominate the index. They're 25 or 26%. So unfortunately, during this pandemic, the big and stronger have gotten bigger. And we've witnessed a lot of smaller companies just get hurt, and some private small companies just unfortunately having a very difficult road ahead and a difficult future ahead. So yes, there's growth out there. It's going to come from new industries. We're going to apply technology to healthcare, which should be very interesting for some companies. But a lot of these smaller companies are still in their early stages. So they still have to prove out some of their concepts of marrying technology with various different new industries.
And so when we think about your focus today in terms of investing, let's talk a little bit about that. What your fund offers.
Sure. So the NORP fund offers best of breed companies in Canada and the US. We invest in what we call at NCM dividend champions, Canadian companies, mostly that have do a very good job in Canada, but have a focus outside Canada's borders, so they can export to large markets. A company like Airboss, which makes specialized rubber equipment and is making other equipment for other equipment used for emergency workers and military for safety. We're looking at some plays in the U.S., a Western Union that has a much lower valuation. Limited Brands, which has a catalyst for the spinoff of Victoria's Secrets, and their Bath and Body Works is not very well appreciated by the market. So we're looking at those type of names that will benefit as consumers get out of their homes. And most of the analysts and economists I see, you're going to see a continued strong consumer spending.
And so within the fund, though, from a market cap perspective, so dividend focus, right. Market cap, especially given your comments about some small cap companies. And, I haven't looked at the stats per se, but, the Russell 2000, it's so important to know. And this is why, people do hire small cap money managers, is because you might not want to own the whole R2K, Russell 2000 companies, because there really are many who aren't performing very well, to your point about bankruptcies and, a shifting economy that is not going to benefit them post-pandemic.
Right. So what we've done with the NORP fund at NCM is primarily have three buckets: Canadian, US, and what we call acorns. We think these acorns are smaller growing companies, but can one day mature into larger, medium-sized firms that pay a dividend. In my fund, I own Storage Vault, which is involved in public storage. I've recently purchased one of their convertible debentures. So that's the focus, recognizing that, as you said, with small cap investing, it at times it can be treacherous because all these companies will tell good stories, but you have to find out what is the path to profitability. And if it's not there, eventually, valuation comes out in the end. So you have to make sure you're with a good management team. The company has a road to profitability. Mm-hmm. And in our case, we'd like to see one day these small companies mature into medium-sized companies and have the ability or commitment to pay a dividend.
Got it. So why don't we take a look at the limited for a moment? What's the dividend there?
So the dividend there isn't that great. It's a smaller dividend paying firm, but they have two divisions. I'll just get it up quickly.
Yeah. I used to cover this company, Mike, when I worked at William Blair. Okay. And it was called Intimate Brands in those days. So Bath and Body Works, Victoria's Secret, and then there was also one other concept they had that I cannot remember. Right. Well, they had the catalog too, of course, but
I think they had Pink, which was more for younger women or teenagers. So as you know, Victoria's Secret's a little bit controversial, as maybe some segments of the population have seen that as not being inclusive, as being too sexist. They've had a complete overhaul of Victoria's Secrets. Everyone except for the CEO of Limited Brands is a woman. They're going to make their products 4 different sizes. They're going to have different female ambassadors from all walks of society, which is great. They're going to spin this out. And so Limited Brands will primarily be left with Bath and Body Works. I think that's a great company. I think they're growing quite well. They have products that really people want to go in the store and try. So there's not a lot of threat from Amazon in that category. And what attracted me to Limited Brands was the valuation. It trades at a much cheaper valuation than the S&P. So you have that good growth, you have a catalyst, and you have people returning to shopping. So that should benefit the Limited Brands.
What's the benefit with spinning it out? I mean, you spin out things to realize value, but it's always operated as one. I'm not, and I thought that, investors were okay with looking at kind of the two components and not thinking that they're so different in terms of what the valuation could be, that they would both attract. Why spin it out?
Well, in some cases, investors want focused retail, and Victoria's Secrets, either you love it or you hate it. And over the years, people saw, Victoria's Secrets portraying an image of women was which wasn't up to current standards. Some of the models were criticized for the way they looked, excessive dieting, or not presenting a good role model for young women. Also, the founder of Limited Brands was a bit controversial. He had, it was in the press that he had a friendship with the disgraced financier Jeffrey Epstein.
Right.
So a lot of those factors, and just the fact that there may have been missteps. Victoria's Secret's got out of bathing suits, and there's different versions of what should be intimate apparel for women. So they wanted to be more inclusive. They wanted to open up the brand. It's got good brand name, but they want to show that they're changing with the times. And the call it the star of the crown jewel, Bath and Body Works, wasn't getting the true valuation it deserved, because it was part of the empire where Victoria's Secrets is. So
got it. Okay. I mean, I've personally been looking for another consumer discretionary name, so I'll take a look at it. I'm wondering, when you think about the limited, though, and you mentioned the valuation, what does it currently trade at around? I mean, I can look it up, but just, yeah, it's hard, because one of the criticisms in the market right now is that the valuations are so high. So it's interesting and always great to be able to find something that trades below the average S&P 500.
Right. So S&P 500, depending what estimates you're using, probably trades at about 22, 23 times. So here you have Limited trading at about 12 times next year's earnings. EV to EBITDA for retailers 7 times. So, I do expect a lot of things. The dividend yield is low, but as you spin out and as you have a more focused retailer that, generates a lot of sales per square foot, I would expect that dividend of the, call it slim down Limited, because the shareholders will get a spin out of Victoria's Secrets, whatever that's going to be called, or Victoria's Secrets, the division could be bought outright by a private equity firm. So I do expect dividends to rise over the years from Limiteds after they do either the spin-off or sale. Interesting.
And what's your view then right now in terms of the consumer discretionary space? I mean, is that an area that you want to perhaps overweight, given the fact that hopefully we're all going to go back to the office sooner than later? And, and people really haven't been buying clothes much for a year and a half, 2 years.
Yeah, it's like your earlier comments. You want to be very selective. So I would say Limited Brands is a unique opportunity. So within consumer discretionary, I would favor, I don't own it now, I've owned in the past, a company like TGX, but there's been a great run up. Costco is a great company, but I wouldn't buy it at these levels. So I'd be very careful on the consumer discretionary side. A staple like a Metro is a company we own. It's pulled back a little bit. Good history of raising their dividend at Metro, and very good operators. They're investing in new storage for their grocery stores and automating more of that. So and making good penetration with e-commerce. I like that name. So I'd be cautious on the consumer discretionary names and investigate it company by company and not just buy the sector blindly.
Yeah, fair point. Let's also talk a little bit about the REIT sector. It's interesting when we've seen some trading days over the past week or so, people seem to be interested and kind of scratching their heads a little bit that the REIT sector has been one that has been leading over the past week or so. What's your view in terms of REITs right now? And again, you don't necessarily want to buy the sector, you want to buy the stocks.
Right. So the REITs usually follow what happens in the US and what happens vis-a-vis the US 10-year and the Canadian 10-year. So as we were discussing earlier, they've come down a lot over the past month and a half. A little bit higher off their bottom, but still very low. Canadian 10 years, I think you could bring it up. I think it's around 131, 132. So there's a lot of hope that people are going back to the office. Industrial REITs have been quite strong throughout the year. there was a little pullback in some of the apartments. So a Killam REIT, taking a hard look at that. Also a Main Street looking at that as well. So those are some of the things you look at as an investor. But right now, core holdings are Granite REIT and Choice Property REIT. So a good solid income. When we're in the midst of the pandemic, you wanted to make sure that your REITs had quality tenants who could pay the bills. So Choice's biggest tenant is Loblaws at about 52%, and Granite REIT has a good blue chip list of clients. Industrial REITs are in quite high demand as the e-commerce in Canada year over year is growing at 40% or more. So those are the type of names. But as I see a general improvement or greater improvement in the economy taking hold and more workers going back to their offices, then there could be room for an Allied REIT or others. But right now, I'm just sticking with the strong REITs for now.
Mm-hmm. But as you say, you're looking at some of the apartment REITs.
Yes.
Yeah. So Killam is KLM, right?
Yes, former corp, and they've turned into a REIT. Original roots in Atlantic, Canada, and they've expanded west, and also that's a name a name I like. Yeah.
Mm-hmm. One that I bought, I feel like it was a year ago. I almost have to check, but definitely a high yield at the time. Was the Smart Properties.
Yes.
So I personally bought that one, as well as Automotive Properties, and got some nice dividends.
Like Automotive Property, they're the only REIT, a smaller REIT in Canada that has auto dealerships. They were spun out of the Diwali group out of Saskatchewan, so they own auto dealerships in Canada. I guess during the pandemic, people were worried about whether cars would be purchased, but very stable business. Essentially the dealer pays rent and maintenance, and anything ever really happens with the auto dealer, that land is very valuable because in many cases it's in key urban locations. So I don't own that REIT, but I've been following it for a long time, and I like what they do. I like their business model. They're unique in Canada.
Well, I'm glad to hear that. So, because I wasn't, I thought it was interesting, and trying to get a little bit of a nice dividend portfolio myself as well. So that was a name I liked. But so we talked a little bit about REITs, consumer discretionary. I do want to talk a little bit about Western Union. Sure. I don't know that that's a name necessarily that a lot of our viewers would be too familiar with in terms of the actual business model. Obviously the name I think most people know, but what's the story there?
Sure. This is a very old company. They actually invented the first ticker tape machine that was used in the New York Stock Exchange. So thankfully their business has evolved, but the story is really about workers going around the world and working. I read a stat on Bloomberg that about 8.9% of the Philippine economy is dependent on or is made up of money transfers from Filipino migrant workers sending money back home. So it's not well known, but one of the most widely downloaded digital apps is the Western Union Money app. So they've got 9 million users with their Western Union digital app. Again, it's a valuation story. It trades at about 11.5, 12 times earnings. They've got a history of raising their dividend about 7.8% over the last 5 years. Good balance sheet, and as the world reopens, we know their COVID rates in some countries higher than they are here in Canada and the U.S. But as the world reopens, Western Union will do well. Also, they're good from a social perspective. They donate a lot. They donate a lot of money to the countries they're in, a lot in emerging markets, and they've got a good franchise, and they've got literally feet and boots on the grounds where people can go into a store, make a little purchase, and collect the money transfer that was sent from somewhere in North America or Europe. So a good franchise, cheap valuation. People sometimes think about they'll be, put out of business by Bitcoin or someone else. But I think really, in those countries where a lot of the citizens don't have even bank accounts, getting money from Western Union is the only way that money is getting from, let's say, the United States or Canada to an emerging market country.
Yeah, I was just going to actually ask you about cryptocurrencies and the potential impact that would have on a Western Union. I mean, I'm sure we're years away, but as we know, if there's even going to be an impact from cryptocurrencies, but that's something that can get, played into the stock when you see crypto move higher. I mean, do you watch that correlation and that volatility? Do you see much volatility in Western Union, depending on who's tweeting positively about Bitcoin?
No, I mean, Western Union, like other stocks, is going to move on earnings and their outlook. So a stat from the Securities and Exchange Commission in the US, I heard in April, was that there are 70 crypto or digital coins or tokens with a market cap of over $1 billion. And there's over 1,000 coins or tokens with a market cap over 1 million. So I can see investors being somewhat perplexed or confused with so many choices out there. And also there's the issue of, I think it's Ethereum. They are a coin that's pegged to the US dollar, or a digital coin pegged to the US dollar. But in terms of reserves, they don't have necessarily a great deal of their reserves in US dollars. They have a high percentage of the reserves in commercial paper. So as I alluded to earlier, there doesn't seem to be any cracks in the credit market yet, but we don't know the quality of the commercial paper they're holding. So that could be an issue down the road.
And it looks as though it has about a 4% dividend yield right now, Western Union, for anyone who cares and wants to own dividend stocks, especially in a low rate environment. And the fact that they're able to increase their dividend over 7%, I guess their cash flow must be very strong and steady.
It is. Obviously, during recessions, it goes down. They're dependent on workers transferring money, but they have roots literally around the world. It's a global company, but as we are forecasting strong growth around the world, and whether we can debate or split hairs as to when do we have peak growth, we're still going to see good strong growth. You may have a new leader over the next 2 years, that may be the US over China, but in an economy that's still growing, world economy growing at 3% or greater, that's good news for Western Union. And they've made the investment in their digital apps. So as their capex comes down, they will have more money to give back to shareholders, either in buying back or raising their dividend.
Interesting. And where's the interest in this company right now? I mean, the fact that it has a more attractive valuation is kind of telling me that not a lot of people are necessarily looking at it.
Yeah, I mean, you can say that it's a company in the quasi-technology space, but they don't have high growth rates. So, you're not going to attract the valuation of a Shopify or other type company. But the interest is, I guess the interest would be from investors who looked at this company, who know that it won't really get a super high valuation, but who realize that this will come out of the pandemic, that they've made the necessary investments in technology. Their digital app is widely used and growing. That's where the new interest would come from. So there could also be, I'm not predicting it will happen, but there could also be a larger technology company or private equity company that likes the network that's been established not over 1 or 3, 5 years, but over multiple decades. So not saying it's going to happen. I don't know what the future holds, but they have built a great network, and it is a great franchise.
Mm-hmm. And Michael, when we talk about your fund and your approach, and it doesn't sound like the way you manage the dividend fund is as traditional perhaps as some people think about running a dividend fund. Absolutely correct me if I'm wrong, because a lot of people I think at home will think that dividends, okay, my banks, my telecom, and my pipelines. I'm sure you have those in your portfolio as well, but maybe give us a bit of an indication in terms of what percentage you would do in terms of those kind of dividend paying companies versus some of the ones we're talking about, which are maybe a little bit differentiated versus what's on people's minds or their understanding of dividends.
Sure. So, within a traditional dividend fund, as you say, you would see great overweighting in banks, telcos, and pipelines. Those are great companies. Within my portfolio, I have a financial weight, which includes insurance companies at about 13.6%. Telcos, I could own, so many. But I own one, or I actually owned one Canadian, TELUS, and Verizon in the U.S. Pipelines, there's also there's a lot of good ones in Canada. I choose to own a company with pipeline assets, but that's not their core focus. It's they have some storage. They do natural gas processing. That's Keyera. So I thought it was the cheapest one at the time, so I bought that, and I'm sticking with it. But you look for companies that are cheaper than the market that still pay a dividend, like Airboss, that start out making rubber gloves for people in different industries. They got into gas masks for different industries, also for the military. So it's a wonderful company. Based out of Newmarket, but they have operations in the U.S. Good valuation, again, in about 13 times earnings, much cheaper than the TSX, and they've been growing their dividend as well. So that's where you look at. As long as the company is profitable, we do our own work at NCM, so we don't need to have 8 analyst buys on it, but as long as it's profitable and I can get a reasonable position in a reasonable amount of time, I can invest in it.
And where are you on the banks though these days, whether it's Canadian and or US?
Yeah, so I think some of the little pullback, I know banks are up today, has been over concerns about growth. So in Canada, I like the dominant bank, Royal Bank, good franchise. You may see a little slowdown in the next quarter in their trading revenue. The next quarter will the last month of July, traditionally a slower month in the markets or in trading and capital markets. I also own TD. They've got a good U.S. presence, or strong U.S. presence, more branches in the U.S. than in Canada. They're a beneficiary of rising rates, and I like the CEO at Bank of Montreal, what he's doing in the U.S. So those are the three Canadian banks I own, and also Intact is just made a number of acquisitions, and they're quite dominant in the Canadian auto, home, and property insurance business.
And what's been your takeaway from those U.S. banks that have been reporting this week? The results look good. Very good in many cases, but at the same time, they're being met with muted market reaction, probably because we've seen such movements already in the broader markets. But what's your view in terms of some of the results and management commentary?
Yeah, the results have been good and strong. In particular, looking at Jamie Dimon's comments, really about the economy being strong and going forward. Even there's some hints, not directly from Jamie, but from other CEOs, that the central bank in the U.S. may be behind the curve a little bit with regards to interest rates. So, loan losses, we're not seeing big write-downs in their loan losses. They're actually releasing reserves, so that's positive. That's been helping out earnings. So, as you correctly pointed out, there was a big run-up, but I like what I'm seeing from the big banks down in the U.S. After we get out of the summer, whether the market goes up or down, you'll see more volume returning. So that'll be good for capital markets. M&A still should be strong, so that's a positive. So you can have a pause in the market in some sectors, or a pullback, but but overall, I like the commentary, the fundamentals coming from the bank CEOs.
Mm-hmm. And, stepping back and looking at, the different dynamics that are going on. And of course, the variants are of key concern, and also the slowing rate of vaccinations in the United States is also a bit of a concern, particularly as we head into the fall. I mean, how are you? What's maybe changed? I want to see in your process, but how you're thinking about the market versus in the past, because we have these unknowns, these variables, and events that could come up. I mean, what do you maybe do differently?
Well, you look at the world also from I call it amateur public health analyst. Every day I check the John Hopkins website. You want to see where we are with COVID. I've been doing that for a long time, since the pandemic started. Interesting stat from RBC. They say even though cases are rising in the UK, their modeling indicates that out of 100 people, you'll have less people being hospitalized because of the rate of vaccination. So we have to wait and see. But the key message from me or anyone is is for the public to get vaccinated, so you reduce the risk of getting infected or being hospitalized. But it's something you watch for. And ironically or not ironically, some countries that get more of their population vaccinated will have an advantage, will be stronger. And I think that's where Canadians are good, because they're getting vaccinated. With the variants, how it slightly changed my view, the number or level for herd immunity, if such a thing exists, is probably higher than when the doctors and scientists first estimated it. It may be 85 or 90%. So
wow,
it's important to get vaccinated. And during the summer, hotter weather, people are outdoors more, and as you correctly come out, the next test for us will be the fall flu season and how it evolves. But as we're getting more people vaccinated, I have more confidence that you'll still get outbreaks from time to time, and you still may see cases rise in the fall. As what great scientists have discovered is that when you look at the southern hemisphere and northern hemisphere, if your cases go up in the fall and winter, that's just the logical seasonal pattern to coronaviruses or any type of viruses. So do expect it to rise, but with more vaccinations, I expect the severity of the illnesses to be diminished, and hopefully, I believe hospitalizations will also be decreased with more people getting vaccinated.
Mm-hmm. Yeah, we almost have to go back to the beginning of when the vaccinations became available to understand that, one of the key goals was just to, obviously prevent death, and part of that was really getting into the hospital. If we can not have to be in the hospital, that's probably a huge success, in terms of what it's accomplished, period.
Yes, I mean, also keep in mind, Bernstein came out with a stat, like on average, it takes about 4 years to get a drug from lab to getting full approval to be vaccinated. So we did this in record time. Moderna and Pfizer are approved by the FDA under emergency approval process. So that's good for science. That's good for private enterprise and industries who invested money into the mRNA technology. So we have the vaccine out there, and it just maybe can highlight or point some direction to maybe some of the Canadian political leaders where they should direct some of their strategic and scarce resources to. So maybe Canada can reestablish its pharmaceutical industry so we can have the ability to produce vaccines on Canadian soil.
Mm-hmm. That would be wonderful if we could come out of it with that as a focus for everybody. That we need to have a little bit of made in Canada, as far as I'm concerned, and probably many.
Yeah.
And why not? We can do it. right? It's unbelievable. We got all this talent and all this land and resources. Surely we can get this done. If there's will. But Mike, when we think about, I guess kind of bottom line investing for you for the remainder of 2021 and then 2022, it sounds as though you're pretty optimistic.
Yeah, notwithstanding, there are seasonal periods in the market. There, could be future, you know, uh, future tantrums with with regards to the taper. But you have to look at it from that perspective. And when you're investing in companies that are growing their cash flow, are trading at a lower multiple vis-a-vis price to earnings or price to cash flow, or have the ability to raise their dividend, they aren't the ones that get hit the most and the hardest in a market sell-off. And when the market sell-offs come, that's when I put cash to work, like I always have. So you have to keep that into perspective. Some of the safe haven stocks, pandemic stocks, have been bid up, but as a company like Clorox has come down, maybe I can take a look at that one again. I don't own it, but currently kicking the tires in Clorox. But like a Costco, a great company, but I don't want to pay 33 times earnings for it.
Yeah.
But similarly, like I wouldn't buy Amazon 5 years ago, but today I own it because the valuation has come down, and I think there's great value with their Amazon Web Services. So it's a market. It's truly after many years, it's turned into a stock picker's market. So value in the market will out in the end, and that's what I have to do, and that's what my unit holders expect me to do.
And just to pick up on Amazon, what does the valuation look like today? I mean, could people step in and buy it today? Because I think so many people missed it.
Yeah, I think so. I mean, I think you have a company growing at over 20%, trading at about, when you X out their cash, trading at about 8.5 times price to cash flow. So, you have a new leader, CEO, which is great. I mean, Jeff Bezos was a great founder and starter, but obviously now he has other interests. If they do ever spin out Amazon Web Services or have that as a separate public company, I think you get a valuation bump, but no dividend. So this is a rarity in my portfolio, but it has the type of growth rate that you don't really see in Canada and you don't really see from a big company. So that's why I own it. And one of the enduring trends that I think we talked about earlier is e-commerce is not going away. People like the convenience. They like to order from their computer. Going back to work, you may not have time to go to the grocery store. So you can choose someone like Amazon, and their Prime service is also doing well. And they recently, a few weeks ago or a month and a bit, bought a major movie studio. So we'll see what they have in store.
Yeah, no, it sounds like a good one to to pick up if you haven't already, for sure.
Yeah, you can't be totally biased against big, medium, or small. You recognize within my NORP fund, I have a bit of both, and for the most part, there are always exceptions. You're going to get higher growth rate with small companies, but there's greater risk. So that's why I have only a small section of acorns, 1 to 3%, and you have to do a lot of homework on the small cap companies to make sure you've got it right.
Yeah, absolutely. Well, Mike, this has been amazing. Thank you so much for the conversation. I love hearing your perspectives and also getting some good stock ideas and really kind of being able to drill down into how you think about these companies and therefore why you own them. I think that's really valuable for people to hear and understand.
Well, I appreciate it, Catherine, and I look forward to doing the next one.
Yay, great. We'll do that.